For the first time in more than 30 years, we are seeing something that should honestly make every thinking person pause. There are two lines on this chart, and they are moving away from each other in a way we have never seen before. One line represents how confident people feel about the stock market, and the other represents how people feel about their own economic future. And when these two completely disconnect, history tells us that something deep inside the financial system is starting to break. The blue line shows consumer confidence in the stock market, and right now it is sitting near the highest level of the last 3 decades, even higher than the year 2000, a time we now remember as extreme euphoria just before the dot-com crash. On the other hand, the white line comes from the University of Michigan survey and reflects how people feel about their own income, jobs, and financial security. This line is currently sitting near the same levels we saw during the heart of the 2008 financial crisis. Think about how strange this is. On one side, people believe the stock market will do great. On the other side, they feel deeply pessimistic about their own lives. This kind of divergence has never been this wide before, and it is not normal. It is not random. It is a symptom of a much deeper problem, one that has been building quietly for years, and that cannot be fixed without some kind of economic reset. To understand where this problem comes from, we need to look at income, not headlines. This chart shows real personal income growth in the United States, meaning how much money people actually earn after adjusting for inflation. From the 1960s until 2008, income followed a fairly stable trend of about 2.8% growth per year. This consistency allowed people to form expectations about their future. They could plan their lives, take loans, buy homes, raise families, and make financial decisions based on what they reasonably expected to earn in the future. This idea is known as the permanent income hypothesis, introduced by economist Milton Friedman back in 1957. But after 2008, something changed. Income growth started falling short of that long-term trend. Imagine someone in 1999 looking ahead 20 years. Based on decades of data, they would have expected a certain standard of living by 2019. For millions of people, that reality never arrived. And what makes this situation even worse is that the gap has recently started widening again. If we look at income growth between 2010 and 2020, we see that after the pandemic, incomes once again failed to keep up with expectations. Someone in 2015 might have expected a certain income level by 2025, but today they are realizing that they are falling short yet again. Now here is where the frustration really comes from. While personal income has disappointed again and again, the stock market has done the exact opposite. If we compare real personal income growth with the inflation-adjusted returns of the S&P 500, the difference is shocking. Since 2010, real personal income has increased by roughly 50%, while the S&P 500 has risen by nearly 300%, even after adjusting for inflation. So people are living in a reality where their work and income are not delivering what they were promised, while asset prices keep racing higher. Deep down, most people understand that this situation cannot last forever. The financial economy cannot stay disconnected from the real economy indefinitely. And this is where the idea of a so-called Great Reset comes in. Some believe this reset will happen violently through a sharp crash in asset prices. If this perspective helped you see the economy differently, share your thoughts in the comments because I read them all. If this perspective helped you see the economy differently, share your thoughts in the comments. If this perspective helped you see the economy differently, share your thoughts in the comments because I read them all and the discussion really matters. And if you want to keep understanding what is actually, if this perspective helped you see the economy differently, share your thoughts. This divergence matters a lot. Corporate profits flow to shareholders, and unlike wage earners, shareholders do not spend most of that income. Instead, much of it gets reinvested into financial assets like stocks, gold, Bitcoin, private equity, and real estate. This is why we see asset prices everywhere reaching record highs. There is nothing inherently wrong with this process. This is how the system is designed to work. The real problem begins when this dynamic spills over into housing. For most of the last 60 years, the average home price in the US was roughly 4 times the average household income. Since the late 1990s, that ratio has climbed to around 7. In simple terms, housing has become almost twice as unaffordable. And since housing is the largest component of consumer inflation, this has a massive impact on household budgets. When more and more income goes toward rent or mortgage payments, there is less left to save and almost nothing left to invest. This means many households remain stuck, watching asset prices rise while being unable to participate in the wealth creation that those assets provide. Over time, this changes how people feel about their future. In the year 2000, about 75% of Americans believed they had a good chance of improving their standard of living. By 2010, that number had dropped to 50%. Today, it is closer to 25%. That is a dramatic shift in just 25 years. And it has resulted in the highest level of wealth inequality in the United States since the 1920s. If we look at the share of wealth owned by the top 0.1%, we see a striking pattern. The last time inequality reached these levels was just before the 1929 stock market crash. Back then, rising stock and housing prices also drove inequality higher. When the market crashed between 1929 and 1940, inequality began to reverse. But that reversal did not happen by accident. A catalyst was needed. If we replace the stock market with corporate tax rates, we see something interesting. In the early 1900s, corporate taxes were close to zero. Over the next few decades, policymakers pushed them toward nearly 40%. This squeezed profits, hurt asset prices, and caused real economic pain. But it also reversed the extreme inequality of the earlier period. In the 1980s, corporate taxes were cut again to revive a struggling economy, and it worked. Growth accelerated and asset prices soared, but it also quietly set the stage for rising inequality. Today, corporate taxes are once again near the lowest levels since the 1930s, while inequality is near the highest. There is no single cause for this, but this pattern explains part of the story. Lower taxes have protected profit margins even as consumers struggle. If a reset comes, it will likely happen when this trend reverses. That could mean higher taxes, lower profits, falling asset prices, and significant pain, just like in the past. The stock market often senses these shifts early, which means it could peak before any official policy changes happen, just as it did in 1929. For now, money continues to flow into stocks, gold, and crypto, pushing prices higher. But when this trend finally flips, the adjustment could be brutal. So the real question is not whether something will change, but how prepared people are when it does. If this perspective helped you see the economy differently, share your thoughts in the comments because I read them all and the discussion really matters. And if you want to keep understanding what is actually happening beneath the headlines, stay connected here because clarity is rare and it makes all the difference.